Hey everyone, welcome to Smart Investing. So today's video, I have 3 banking stocks for you guys. We're gonna go over as much financial information that we can. I'm on a little break, so I only have about 15 minutes or less. So we're gonna do this video in 15 minutes or less. Today is January 4th, 2024, Thursday. And again, for these stocks, this is going over the banking sector, also known as the banking services sector. First stock up that I have is ticker symbol HOMB. Stock market is open, so again, I'm just going over these 3 stocks. So if you do see the price go up and down, it's because the market is open. So right now the price for this stock is at $24.61. Market cap almost a $5 billion company. So we have a company that does pay dividends, 72 cents, 52-week high and low. It looks pretty bad for that range. Earnings are only a measly $2 per share for the year. I think that's pretty horrible. But assuming for a market cap of $5 billion, I mean, it is what it is. PE ratio is about 12, so that's telling me it's slightly undervalued. Price to book is at 1.3. Price to sales is at 4.9, close to 5. So just with this stock alone, we have here some charting. So looking at the 5 years for this stock, we can see middle range of about, I don't know, 18 bucks. It is way above the 18, so it is in that range between 18 and about it hasn't broken new highs, so 18 and 26. So we see these jumps here even previously in 2021, and we see them in 2022, 2023, now 2024. So there's a lot of jumping around and volatility these banking stocks. So looking at the 5-year trend, that would have been a good time to buy, and this would have been a good time to buy right here, right under the 200. And yeah, you're just gonna have these pops go up and down. So looking at the charting, I'm trying to look at the charting. Does it look like a good chart? I don't know. It still looks pretty neutral to me. But again, neutral can be good because you have ups and downs, whipsaws. It's not going anywhere. It's just you're just within that range. You're just trading between a certain range. So we have 8 analysts that covered this. So I'm sure 4 people voted for 50%, and then 2 people voted it's a buy. The other 2 rated this as a strong buy. Obviously they're going to recommend buy. They're not going to recommend sells because Wall Street likes making money, obviously, as greedy as they are. So the highest number for the quant rating that we have is at 5.8. It's showing me income. This is not, obviously it's not a high number, but that's the highest number from that. So it's telling me the best factor for this stock is actually for the dividend. I just don't see it happening. I think the rating is actually lower than that. Lowest rating for this is the value. I do agree with that. I don't know what number, but I guess I do agree with the fact that, again, the banking sector is not a good sector to be in. It's actually one of the worst sectors to be in as of last year, and I'm still making that case for this year. So looking at the financials here, we want to see some earnings. So we see downward earnings revisions here. That's pretty expected, I would say. And we have here, obviously they haven't reported earnings yet, But it looks like they beat estimates. They beat estimates. They beat it. They beat it. And now they're looking for a beat. Makes things easier when things are on a downward trend. And hopefully those cost measures can be avoided. We're looking at the other key indicators here. So we have ROA 1.49. Comparing to the last 5 years, it looks like it's at its lowest, but still between that range of like 1%. Oops, sorry. ROE, it's at close to 10%. Earnings per share is at 1.5. Then we have the net margins at 33%. They're pretty high. Debt is at 84%. It's pretty high. Cash flow per share. Cash reserve is at 11.7. Again, I don't care about those three. But net income is at 305. So pretty stable. I mean, better than most of the previous years. Obviously 2021 was a big year, so about the same as 2021. Revenue for 2022 is highest it's ever been, so they're doing good on that end, which I would suppose for any company that would raise revenue. So now we're going to look at the balance sheet. Obviously 84% of debt. Cash flow, biggest factor here. So let's combine that. So we're looking at about wow. At first it was 600,000. Negative 600,000. So now 2.9 billion in negative cash flow. That is not good. So obviously they're collecting debts that are needing repayment. We just don't know when. So obviously those debt percentages might remain high for a while. But again, for this year, they have raised their debt to its highest. And again, that's only for 2022, not for 2023. And things are gonna get worse. I haven't seen evaluations this bad. Again, ever since I've started this evaluations for the banking services, they're looking really bad. And then the funny thing is, they don't even want to cut dividends. You don't see dividend cuts. They still want payouts and everything. So it just, business makes no sense. So obviously this stock is horrible. From a technical standpoint, it's not even worth it. Even for the long term, it's not even worth it. Even comparing it against its peers, it's not even worth it. So again, I'm gonna say no to this stock. That's an obvious no. Move up to the next one, ticker symbol PACW. PACW, so last 5 years on a downtrend, has not held up against its 2020 highs. Actually, it's gone down ever since 2023 with the banking services sector when we had that crisis. So this company, actually looking at it, it actually got delisted, and I could see why. You know, not even $1 billion company, and then obviously these numbers in that chart, probably horrible. Earnings are negative 11. Dividend is only a measly 4 cents. That's just horrible. Nothing. The range is okay, but again, they're just not earning anything. So eventually, you know, something's got to give. So we're gonna move on to the next stock because this one got delisted. So we only have one more for you guys. Ticker symbol CFG, Citizens Financial Group. So again, if you see the share price moving up and down, it's because the stock market is open. pretty active for the volume here, looking at 1.17 million, market cap of about 15 billion. Then we have here earnings per share at 4. We have here PE ratio at 8. Forward PE is at 9. Looks pretty undervalued. Dividend percentage is at 5.16, higher than others. Dividend amount is at 1.68. Dividend range is at difference of $22, so definitely a good range. I can certainly confirm that it's a decent stock if you are wanting to trade this. But again, I can't say short term or long term. It just looks pretty decent. I got to dig in some more financial data and look at some charts. Looking at the 5-year, it's keeping up with its 2020 highs and the 200 EMA just right below that. Again, this is not a sector to jump into, even though it is undervalued. So again, I would not recommend this stock. Not personal reasons, just based on the data that we have. Again, you have these whipsaws from 2020 going up, and then all of a sudden, obviously, every stock went up in the world for 2021. 2022, we took a breather. 2023 was pretty mixed. More downs than ups, and then now in 2024, the last 2 months of 2023 were insane. Pretty much all year we were down, and the last 2 months, November, December, went up. And then now, first week of January, looks like we're slightly going back down, which seems pretty normal. So anyhow, it is pretty much still keeping up with its 200 EMA. Really huge gain though in the last 2 months, like many other stocks, with this fake rally. Moving on to the analysis so we have 21 analysts on this. Obviously, we're going to recommend a buy. So the majority voting for a holding off, and then the other half, pretty much half and half, saying that it's a buy. Analyst targets, they're saying 25 minimum and then a 45 max, average at 34. I'm not going to go with that. I always go with what I see in my chart off of the 5 years. So we can see a range of about, I'll tell you right now, so about 23 with a high of about 45 to be on the safe side. So we're only looking at about $20 difference between that. Not that much of a big range. Let's look at some quant ratings. The income we have is the highest factor. The value is the highest factor. Growth is at 4.13. Momentum is the lowest at 3.2. What is that? 8 or 6? So it's an 8. I highly doubt that number for momentum is at a 3, unless I could be wrong last year that they had less volume. But as of today, right now, the market is open. It is 11:30 Eastern Standard Time, so I'm aligned with the actual time with the stock market. So again, it's really, really active. Maybe last week it wasn't, but for this past week it has been. So value, it's hard to judge well, not really, not the value, the quality, because I'm not a customer. I don't use that bank. But anyhow, we're going to dig into some financials and then call this to an end. Coming up on my time, close to 15 minutes, so I got a few minutes left. So we're going to look at the gap earnings. So we have here downtrend again for this banking sector stock, a downward revision. They haven't reported earnings for Q4. I don't care when they're going to report it, but it is what it is. Looking at the annual estimates, I only have 2023 and the Q3. Let log back in because it's not showing me the data. So there we go, CFG. I apologize for that. It's probably delayed. So annual data that we have for 2022, ROA is at 1%. Looking at the last 5 years, it looks about the same, which is good. ROE, about the same. 2020 they actually did really bad. Even though they did worse in 2022, nothing for 2023 yet. But again, they did slightly worse in 2022 than 2021. Earnings, I would hope they did about the same, but they have not. They went from earnings of 5 to a 4.1. Net margins have dropped as well. The debt has actually gone up, which is not good. 2% pretty much. That's a 2%. Again, to be exact, you see it here, 2.26%. These are not good numbers looking at these key indicators, and I highly look at these factors. I look at all these numbers, but again, from what I'm seeing, it doesn't look good from a fundamentals perspective. So I can't say if this company would survive. I mean, they're a $15 billion company, so who knows? But again, they're in the smaller scale of the industry. So we have here net income dropped around 10%. We have revenue up from 6.65 billion to 8 billion. And then the net income went from 2.32 to about 2.07. It's not too bad, understandable. But again, the debt, that's what's killing it. Horrible. So, biggest factor here, I'm not saying that, I'm gonna disregard the other factors, but to me, in this order, cash flow is the number one for the banking sector. So we have operating at 4.12. Again, these are 2022 numbers, but again, we can still determine the way this company is going. So we have here negative 12.6 billion. So that leaves us with about 8.5 of negative cash flow. So then we have 9.9. So we're looking at about 1.4 billion in positive cash flow. So we have 1.4 billion in positive cash flow. So that's a plus. What are the dividends now if they have positive cash flow? 1.68 per year. So that's actually not too bad. I think they can afford the dividend. Buybacks, I don't know. I don't care. Those are other numbers I don't even want to get into. Those are not a priority or nothing of importance or relation into the factors that I look at. So again, decent stock. If you want to add this to your watch list, to be on the safe side, I'd say no. Again, the banking sector is not one to look at, but again, it's pretty active. If this keeps up till next week, I guess you can try to add it to the watch list. If it remains active for at least another week, hopefully 2 more weeks, then maybe you can consider momentum trading, jumping in and jumping out. But other than that, overall, I would not recommend the stock, not even for the long run. Again, they're one of the smaller banks, and that is just because of that. Really one of the main reasons. Again, they're okay, but they're not one of the best. So there you have it. I said no to all these stocks. So just a quick recap: no, no, and then no. But again, this one just needs more work to gain more revenue and, you know, lower that debt. It's not fun. Not fun to see companies skyrocketing their debt. That's the way of the banking world. So, you know, it is what it is. So thank you guys for watching. I'll see you guys in the next one. Take care. Happy New Year's. And I'll continue to make more videos and finish this sector off. So again, thank you guys for watching, and I'll see you guys soon.